Good morning, everybody. Welcome back to another installment of the Million Dollar Question. I'm Stephen Weitzel, managing partner, Reveille Wealth Management. We've got a lot of stuff going on. I'm going to start out by saying that Reveille continues to be on the move. We are excited to announce that we have our fourth office opening in Augusta, Georgia, little town near and dear to my heart. Love spending the first full week of April every year out in Augusta. And so now we will have an office in Augusta, physical location that I believe is going to open on March the 1st. But we're very excited about that. And there are so many great opportunities to continue to expand here at Reveille. If you're a financial advisor out there and you're dissatisfied with your current circumstances and want to be a part of a growing and differentiated brand, reach out to us. Send us an email, info@reveillewealth.com, or you can hit me up on Twitter, LinkedIn, whatever. Would love to have a discussion with you out there. Now, last week on the show, we were talking about technical analysis. We had just come back from the Portfolio Accelerator event down in Miami, and we were talking about how financial advisors could implement technical analysis into their investment process. And that could be as simple as aligning with market trends instead of trying to predict where the market is going, right? We're not here to try to predict where the market's going. We've got a 50-50 shot at that at best. But if we merely mute the noise and our opinion and emotion about the market environment that we're in and simply align with the trends, we're probably going to help ourselves and our clients out in a big way. The second piece was from an intermarket perspective, the way that you're allocating capital, right? Large caps versus small caps versus international stocks, emerging market stocks. How much duration do you want in your bond portfolio? Instead of having to distill a mountain of information and try to make an educated guess about that, what if you simply align with the intermarket trends that are out there? Going to help you out a lot. And we ended that discussion last week by showing how incorporating some basic technical analysis can help you manage concentrated positions for clients. You establish risk levels, stops, prior floors, where if the stock breaks back below that, you're probably going to want to sell and come out. But the way that when we're managing options strategies around those concentrated positions, income enhancement strategies, that we use technical analysis to help us identify the strike prices that we want to be writing. And I'm really surprised that that's not more of a pervasive manner to manage option strategies, income enhancement strategies in our industry, but it's something that we do every day here. So, but today we are zooming out. We are not talking about investing so much as we're talking about planning. This is tax season, and we're going to be talking about Roth IRAs. The Roth is the greatest investment savings vehicle that we have available in this country, as far as I'm concerned. And we're going to talk about ways that you can maximize the amount of money that you get into it. So because it is tax season, we're probably going to do a handful of shows related to ways that you can be either increasing the amount of money you're putting into Roths. If you're a business owner and you are looking for tax shelter, we will probably do some of those as well. Talk about some tax shelter opportunities for business owners in some subsequent episodes. But let's dive in, and we're going to look at maximizing Roth savings. And this is for individual investors. It's for business owners as well. But we're going to talk about why we want to focus on Roth, how you can maximize the amount of money you get into it, and then some other options that are available for small business owners, right? So, all right, so let's jump in. Okay. Quick disclaimer, I'm going to keep the attorneys happy around here. We are not providing you legal or tax advice here today. Everything that we're going to show you is going to be for illustrative purposes only. We're going to have some hypothetical scenarios that we look at, but go to irs.gov, consult your tax advisor for further guidance there. Okay. Let's just kind of set the stage here. Most people are familiar with traditional retirement plans, meaning pre-tax. But I just want to delineate between the two here. So in a pre-tax retirement plan, the contributions that you're going to make into that plan are more than likely tax deductible in the current year. The salary deferral that you put into it, the money you put into your 401k, the money you may put into your IRA, pre-tax dollars. When you're whatever money you put in there, you are deducting that on your tax return. Okay. The dollars in that account, they grow tax deferred, meaning the income, the gains that you may harvest in there, the appreciation that happens over time, you're not paying taxes on that on an annual basis or as you would incur those gains or that interest or dividends. But you are going to pay taxes on it when you take the money out. When the money comes out in the future, it's going to be taxed as ordinary income. And if it's something that's been moved into an IRA, you've got to be 59 and a half for all intents and purposes. I'm not going to get into some of the other rules here today, but for a rollover IRA or for an IRA, 59 and a half and older ordinary income tax. If you're taking it out before 59 and a half from an IRA, presume you're going to have a 10% early withdrawal penalty. But from your 401k or another type of employer sponsored plan, that could be a 403b, it could be a 457, that those plans, the dollars that you leave in the corporate retirement plan, if you're separated from service at 55, you can make withdrawals from those accounts and only pay ordinary income taxes, no early withdrawal penalty. So I'll just throw in one little caveat here. If you are an executive or somebody who is retiring early, before 59 and a half, do not be quick to move money from your 401k into an IRA just because your financial advisor tells you to do so. Because unless you're going to start substantially equal payments or you have money outside of your retirement account that you're going to live on, you want to keep money in your company 401k plan or the 403b so you can access that money without an early withdrawal penalty. All right, so just nice little caveat there. All right, all company contributions that go into retirement plans, whether it's a safe harbor non-elective contribution, a matching contribution, if your company does profit sharing, all of that is pre-tax. The other thing within these traditional retirement plans is you have to take required minimum distributions in the future, right? So if you're taking a tax deduction when you put the money in, the government is going to require you to take the money out so that it can be taxed sometime down the road. Now, with Roths, the contributions that you put in, you're not writing that off on your tax return. So you have basis in that account. Historically, right now, I said at the top of our discussion today that Roths are the greatest savings vehicle that are available to the American investing public. And for a long time, they prohibited or excluded high income earners from being able to make contributions until until about 20 years ago. Pension Protection Act changed some of that, where they allowed 401k plans to adopt the Roth contributions. But for conventional Roth IRA contributions, there are still income thresholds that if you make above a certain amount, you cannot contribute directly to a Roth IRA, but there is no such limit within the 401k plan or a 403b plan with a Roth provision. You can make as much as you want, and you can still make a salary deferral that is after tax. Those accounts, they grow tax-free. The distributions that you take in retirement are not subject to income taxes. And importantly, there is no required minimum distribution. So for a lot of people, the Roth can turn out to be a great estate planning tool for you because it's money that you can pass along. You have designated beneficiaries on that account, so it avoids probate, and there is no income tax due on those dollars going to your beneficiaries. Now, I'll say this, just keeping it real simple. Uncle Sam is your business partner in your retirement savings journey, and you get to determine when you're going to buy him out. If you're doing the pre-tax, the pre-tax contribution, then, and that's what most people are doing. If you're going to take a deduction today, then you're going to have to buy him out down the road. But if you're going to do Roth, if you're not going to take a tax deduction on the contributions that you make today, then you're buying him out today. You're buying him out up front, and you don't have to pay him anymore down the road. So just keep that in mind, right? When do you want to buy Uncle Sam out? Now, you can take money that you have inside of a pre-tax retirement account, and you can convert it into a Roth IRA at any point in time. And you can do it with any amount of money that you want to. The caveat is, and it's a big caveat, is that you got to pay the tax on what you convert in the year that you do it. So we just got an example on here. You're 62 years old. You're retired, living in Florida. You got $100,000 in income. You got $2 million in a pre-tax IRA, $1 million in savings. And you decide, I want to convert some of my pre-tax retirement account into a Roth because maybe I'm concerned about RMDs in the future, right? Now, so in this example, if I'm 62 today, then I was born in either 1963 or 1964, which means that my RMDs would not begin until I'm 75 years old. So the Secure Acts, and more recently the Secure 2.0 Act, it pushed the required minimum distribution age out a couple years, right? It used to be 70 and a half. It went to 72, and then now it's either somewhere between 73 to 75 for required minimum distributions. And so for this person, right, they would have 13 years for their retirement account to grow. Over that period of time, if they're not touching it, I mean, it could double. And they're talking about pretty significant required minimum distributions in the future. So if they wanted to convert some, and this is the type of very basic advice that we would work with an accountant to come up with, that if you've got $100,000 in federally taxable income, then you've got, you're already pretty much in the 22% federal bracket for married filing jointly. Okay, you can go and pull up the tax tables, look at them. 2026, married filing jointly, above $100,800, I think it is 22%. That tax bracket is in place until you get north of $211,400. So what we would tell this person working with their accountant late in the year, when we already know how much income you've got booked for this year, you can convert up to the ceiling, staying in the 22% bracket, convert $111,400. You're going to pay the 22% federal tax on that conversion. So you're going to have to pay $24,508 in federal taxes. Now, After you've done that, and this is presuming that there isn't any investment return, okay, you've gone from having 2 million in your pre-tax IRA to now you've got 1.88 million. You now have a Roth IRA with 111,000 in it, and then you've depleted your savings by $24,508. You've paid the taxes on that conversion amount. Importantly, right? So there's no income limits or anything on this. You can convert as much money as you want, regardless of what tax bracket you're in. You're going to have to pay the taxes, but you want to make sure when you're doing these conversions that whatever amount of money you take out of your pre-tax retirement account, that entire amount needs to go into your Roth. Okay, you could do this at 52 years old, 42 years old if you wanted to. But if you don't convert the entire sum from your pre-tax retirement account to the Roth, then you could potentially have an early withdrawal penalty. So you've got to convert the entire thing. Okay. Now, so we talked about Roth conversions. Anybody can do them, regardless of how much money you make. You simply have to pay taxes on the conversion. So you can get money into Roth at any point in time. But let's talk about the first little loophole that exists in the tax code. And this is the backdoor Roth IRA contribution. Now, we talked earlier about how conventional Roth IRA contributions are subject to income thresholds. And if you're above those phase outs, then you can't make a contribution. But maybe there's a way you can backdoor your way into it. So this is how it works. You have to have all of your pre-tax money. It needs to be inside of an employer-sponsored plan. You cannot have money in an IRA somewhere, okay? All of your pre-tax dollars need to be in your company's retirement plan. So presume you're still working. You're still, you still are earning a nice wage, but you're going to open another traditional IRA account somewhere because you make a certain amount of money and you're already covered by an employer-sponsored retirement plan. The contribution that you would make to a traditional IRA is highly likely to be non-deductible, right? The government will allow you to make a contribution to a traditional IRA regardless of how much money you make, but they do not promise you that it's going to be tax deductible. In this case, we're going to use that to our advantage because that non-deductible contribution that's going to exist in this separate retirement account that we set up, that's the only thing that it holds is the $7,500 contribution that we put in. This is for an individual who's, say, less than 50 years old in 2026. You're going to put $7,500 in there, non-deductible contribution. You're not going to write it off on your taxes. And as soon as you do that, you're going to convert that $7,500 into a Roth IRA. And when you do that, you've got zero taxes due on that conversion. Why? Because you've got basis here. You've paid tax on this $7,500 already. And so as long as this basis is the only thing that exists in this separate traditional IRA, when you convert it to Roth, you've got no taxes due. And you've just found a loophole to be able to make a Roth IRA contribution when under conventional standards, you weren't going to be able to make one in the first place. Now, let's move on from there and see how can we juice it up even further. How can we do a lot more than $7,500 a year getting money into a Roth IRA? Well, we're going to need to use the employer-sponsored plans where the IRS 415 limits, which is the cap that they set on the amount of money that can be put into a defined contribution plan are substantially higher. So in 2026, for individuals 50 and under, the 415 limits are $72,000. Okay, if you're over 50, you're going up to $80,000, and then there's a little special exemption for 60 to 63. Not necessarily going to talk about that today, but inside of these company retirement plans, there are 3 different savings buckets that can be filled up. The first one is your salary deferral, how much money you are taking out of your pay to put into your 401k. The second is the amount of money that the company is going to put in there, either as a matching contribution, it could be a non-elective contribution, it could be some profit sharing dollars, but it's the company's money. It isn't yours if you're an employee there. Now, if you're a business owner, it's kind of one and the same, but the way that you account for it is a little different. The third, and this is one that doesn't get a whole lot of press, is the after-tax contributions that you're going to be able to put in. So we know that you can only put in, if you're under 50, you can put in $24,500 into your 401k, 403b in 2026. If you're over 50, you can put in another $8,000 as a catch-up contribution. And if you're 60 to 63, you got a super catch-up to $11,250. Now, one thing that did change in the nature of our discussion today is we are pursuing maximizing the amount of money you can get into Roth. You're like, look, I'm willing to pay the tax today, so I never have to pay the tax again. I got good news for you. If you're a high income earner and you're over 50, the government's kind of helping you out right now, because starting in 2026, all catch-up contributions that are made into these retirement plans, if you make more than $150,000 a year, they are now obligated to be Roth. That's new for 2026. Okay, so they're helping you out there a little bit. So how can we get this mega backdoor Roth? How can we really maximize the amount of money that we're putting away on an annual basis, paying the tax today so that we never have to pay taxes on this money again? So I'm 50 years old. I'm earning $400,000. And my company has 401k and they do safe harbor match. So I'm going to, the first thing, right, and there are a few caveats that the plans need to allow for me to be able to get the maximum amount of contribution in. Okay. The ultimate punchline here is that if you're 50 years old or more, you can do $80,000 a year mega backdoor Roth. We're going to see how we get there. Okay. So the plan, the 401k plan, needs to allow for Roth salary deferrals. It also needs to allow for after-tax contributions, which that's kind of hit or miss in a lot of company plans. But then they also need to allow for in-plan conversions and then maybe some in-service withdrawals, and I'm going to tell you why. Okay, so I'm 50 years old. I'm putting in my $24,500 of salary deferral, and I'm electing to do that as Roth. So I got Roth dollars, $24,500. Let's come down to the company or to the catch-up contribution. I'm over 50, so I can make one. I'm going to do that as Roth. I'm highly compensated. I make over $150,000 a year in this example, so I'm obligated to do it as Roth. That's another $8,000. Now, the company match, they can only match up to what they call the maximum considered earnings threshold, that for this year is $360,000 for these ERISA covered plans. So they're going to match me $14,400. Okay. If this is safe harbor non-elective, it's 4% on that amount of money. Just take my word for it. You do the math, $14,400. So sum that up, $46,900. Well, the IRS 415 limits would tell me I could put in $80,000. So I need to do a little math late in the year. I still have $33,100 that I could put in there as an after-tax contribution. If my company's retirement plan allows me to make an after-tax contribution, then I can do that. I can put in $33,100. Now, what I need to do to make all of this Roth, clearly my salary deferral and my catch-up were already both Roth. The company match that they put in there, I need to reach out to the record keeper, wherever this 401k is, and I need to tell them I want to convert that company match to Roth inside of the plan. Now, I'm going to have to pay taxes on that. It's going to show up on my W-2, but I can convert as long as the plan document allows for in-plan conversions. I can convert the company match, which we looked at earlier. All of those company contributions are pre-tax. So I'm going to have to take the initiative to reach out and say, I want to convert that to Roth, but I can do that. And then for this after-tax contribution, typically that's something you're going to want to do late in the year. And as soon as you do it, as soon as you make that after-tax contribution, I want you to make an in-service withdrawal of the $33,100 where it really hasn't grown. You've put the money in there late in the year. Maybe it just went into a stable value or something like that. We want to roll that amount of money into a Roth IRA. If it has grown at all, then we have to pay tax on that. Okay. And if we're not 59 and a half, we're going to have an early withdrawal penalty on that. Okay. Because we're not separated from service in this example. But if we do those things, then we can put 80 grand a year into Roth for ourselves. In this example, somebody's 50 years old. Imagine they're going to work for another 15 years. What's the value of that account going to be over time? And they're never going to have to pay Uncle Sam another dime. That is incredible. Now, let's talk about a couple other options for small business owners. And it's really just one. If you are a small business owner, then solo Ks are an option where we can help you with the proper plan design, incorporate all of these things. And if you have staff, then you need to do that. But if it's just you, or maybe just you and your spouse, then the SEP IRA could be a very good solution for you as well. Now, the threshold is not quite as high. The maximum amount of money that you can put into a SEP for 2026 is $72,000, which is that IRS 415 limit. There's no catch-up contribution in the SEP that could take it to 80 grand. But the administrative burden for establishing one of these, so much lower than the 401k side. But the issue is, and the reason you would not do this if you have staff necessarily, is because what you elect to do for yourself, as far as percentage of salary or the percentage of income that you put in, because the SEP contribution is all company contribution. There's no salary deferral. The company's making the contribution. And so you establish it as percentage of wage. So it's the lesser of 25% of wages or 72,000, whichever is less. But whatever you choose for yourself as the business owner, whatever that percentage of your income is, you've got to do that for the people who work for you too. So this is, as the old timers where I come from would say, what's good for the goose is good for the gander. So if you've got a lot of people working for you, you may not want to do this. You may not want to put 20% of their wages into the SEP. Maybe you do. Maybe you're a very benevolent business owner. And if that's the case, then you might want to look at some additional plans like a cash balance plan or something like that. We'll talk about that in some of our subsequent videos. But if you are a single member entity, or it's just you and your wife or you and maybe your kids, the SEP now with Secure 2.0 going in place a couple years ago, it now allows for the contributions that go in there to be Roth. So the company contribution is still tax deductible. Okay, still tax deductible contribution on the company's books. But before the contribution is made, the employee has to elect that it's going to be it's going to be Roth. And then that contribution that goes in is going to pass through, and it's going to show up on their W-2 as phantom income, essentially. So you've got to pay taxes on it up front, but you're not going to have to pay taxes on it anymore going forward. Okay. So that's a good option for small business owners. If you're working alone, or, it's just you and your wife, husband, your kids, where this SEP is maybe more conducive to that. If you have a larger staff, then you're going to need a plan that provides for a little bit more discrimination inside of it. So, okay, that is it for today, everybody. I hope that this has been helpful for you, giving you some insight on what you can do to maximize the amount of money that is going into your Roth savings vehicles. The Roth is the most powerful savings account that we have available. But we've got to be willing to buy Uncle Sam out up front, but we never have to pay him tax going forward on all of the growth that account experiences over time. So if you have questions, shoot us an email, info@reveillewealth.com. We are still working on our mailbag segment, so feel free to email us in with questions, case studies, things that you're working on, and we'll read some of those here on the air. Additionally, so today we obviously talked about how we can maximize Roth. We got into a little bit about what we can do for business owners. We have a very solid corporate retirement segment here at Reveille. We do a lot of corporate retirement planning and consulting, and frankly, we need people to come and help us manage that segment of our business. And so if you're a financial advisor, if you are a TPA who's maybe grown a little disinterested in the plan administration and would like to actually be on the front lines of being able to service these plans, shoot us an email or hit me up on Twitter or LinkedIn. We would love to have a conversation with you. This is an area of focus for us. A lot of financial advisors, they don't understand the corporate retirement space, and it is a core competency of ours, and we want to continue to grow this, but we need more human capital in this area. So please let us know if you might be interested in joining us on that front. All right, that's all that I have for today. Thank you so much for tuning in. When we are back next week at the beginning of February, we're going to be doing our monthly review. I'm going to be sharing with you the same thoughts that we are sharing with our clients in terms of how we've gotten started here so far in 2026, making sure that we have their investments aligned with the trends of today's market. And wow, January has been pretty solid across the board, especially for the diversifiers in your portfolio. So we're going to be talking about that next week. Be sure to tune in, subscribe, Stock Market TV, set your notifications, and we will see you next week here on the $1 Million Question. Take care.